Pretty usual living on this channel is for educational purposes only and is not intended as financial advice. It's Tuesday, Teaching Tech Tuesday. Let's talk about something I talk about in almost every video. I had a question about fibs, how to draw them, which ones to use, where to select the highs and lows, that sort of thing. So as a man of science, technical analysis is certainly more art than science. But based on my own lived experiences, there is no more important number than the 1.618. It has made me probably the most number of profitable trades, has the highest hit rate at giving you some idea of where price may go. And it is a guide point, it is a fence post, it is a suggestion of where things may go in the future. So I'm not going to talk about what fibs are, but there are plenty of articles that do talk about that. I don't care why it works. I'm just here talking about it because I know it works, at least for me, right? So I'll leave these two articles in the description for you to peruse at your own leisure, and I'll get to the fib tool in a minute. But the first thing you want to do when using fibs, or at least on any chart, typically you want a defined range that you're looking at, right? Because the first thing you need to identify is a high and a low. So unless you have a high and a low to identify, you don't really know where to start to draw this stuff. Typically, I use the wicks, an extreme high in this case, a local low in this case, that's what this is called, local low, or some imagined level, right? This isn't perfect. This is giving you a rough estimate of where you think things could go. Okay, once you have the defined range, then you can say, all right, is this anything else, right? Is it a chart pattern? Is it a trend reversal? Is it blah, 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 blah? And that tells you which direction to draw the fibs. So the fibs are here. The fib extensions is anything beyond 0 to 1. If you are looking at a bearish move, that'll be pointing the extensions downward. If you're looking at a bullish move, you'll be pointing the extensions upward. Extremely important note, 0.5 and 1 are not fibs, but they are on the fib tool and are very important. Again, the 1618 for me is the most important, especially with chart patterns. You know, it goes like this. You open a chart, you figure out if there's a range. Does that range match any previous fractal historically that we all know and are aware of? Then you pick the high and the low, fib extensions accordingly. And then you have a full map, complete, of entry, exit, stop loss, solely based on made up numbers that are important in nature or something, right? It doesn't even matter for me, because I've lived this, I know it works for me. Ultimately, you have to get to a point where you trust it for yourself so that you begin to have certain expectations for direction, for price, for levels, bids, asks, that sort of thing. So just on the S&P, talk about this every week, but currently we have this head and shoulders, and based on the fib extensions, 16.8 at a minimum is at 4160. And then with the fib tool, I typically add the 2 value. And then this gives you a range at which price may go. It gives you some idea. That way, if you're short, you know where to go short at the horizontal support in this case. If you're looking to cover that short, if you're looking to add bids at a level, the 1618 or below is certainly where I would expect this to reach. And this may be obvious, but the depth of the extensions are based on the depth of the range. So it's pretty straightforward. And most importantly, it's super easy to do this every time instantly. You know, I'm not thinking like, oh, do I use the 16.5? Do I use the 1376? No. I never change that. I always look at this. You know, the 1.272 is another level I'll talk about, but just very simply gives you a roadmap of where we might be going. And occasionally, really more often than not, honestly, we have not a super specific horizontal level, but you get a vague, rough horizontal level. You know, as this was forming throughout the end of 22 and the early 23, we didn't exactly know where this would go based on any specific horizontal. But as you get towards the end of a range, then you get a better idea and you're more comfortable with saying, okay, I think this will go here. You might not have known that in October, but by January, certainly, I was talking about it. I know no one seemed to believe that that would happen, but it did, okay? It didn't have to happen, but it says, hey, look, once we have this range defined, we're going to take this range high, this range low. It's fuzzy sometimes, it's not perfect. Do you use this wick? Do you use the candle body? Do you use the range with more candles? That's up to you. You have to get comfortable with that. Most of the time, if it's a straight horizontal pattern or range, it's pretty obvious, but You can bounce around the time frame, so you can go up the time frame, down the time frame, look for relatively important levels. And then as this is continuing to form, this whole time, you're getting an idea of where this could go. And this was in January, this was in February, right? This doesn't change because we had a defined range for the S&P. So once we get to this level, I say, okay, yeah, that's probably enough. You know, I know a lot of people got bullish up here. This is typically the case. People get extremely bearish at the bottom, extremely bullish at the top. You know, AI is going to save the day or whatever the narrative is. Meanwhile, people paying attention to the range and the fibs are saying, look, this is the range where it could have gone based on the consolidation. So yeah, it looks to be good enough here for me, right? And this may adjust depending on which levels exactly you're looking at. But the point is this value was telegraphed months in advance. And you just have to get comfortable with being able to predict the price. You do, okay? It's a dangerous thing to say, but you do. And how you act on that, I'll give you a link example in a minute. But one way to act on that is say, look, I want my asks for a long position to close it out somewhere above this 4,500 level. So you can have those on the book as people are scrambling, you know, to figure out what they're doing in May or later. You've already have your trading plan well in advance, where you want this to go, where you think this will go, and you'll have bids on the book. Or ask on the book in this case. You'll be ready already, right? There's nothing to do. Once you have a defined range and the fibs, that's it, right? Easier with patterns, harder with trends, but I think you get the point. You know, it helps you prepare ahead of time. So before we get into more specific examples, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. So if we want to locate the Fib tool, this is on the link chart, mainly because I know everybody's familiar with it for the most part by now. So this is the link on the weekly. We want to locate the Fib tool. It's on the left here. It's called Fibonacci Retracement. Your colors might look a little different than mine. Your font or whatever. You know, I tend to get rid of the background and make it one color. I'll take that off. I'll get rid of the trend line as well. And then which levels you use are up to you. But again, most important for me is always the 1618, hands down every time. Okay. So here's the link. Here's our defined range. And it may help some people to, you know, draw horizontal levels here. I'm picking levels that have multiple touches that to me make sense, right? Now, eventually you'll get comfortable enough with this that you're making sort of a range that isn't necessarily maybe a specific level, but you can use that to then adjust where you'll draw your fibs. So we have our high here, we have our low somewhere in this range. Because we're drawing the fib extension higher, you start with the high, finish on the low, and then we get our fib extensions. You know, typically see me draw in like a square here, just as a visual to say, hey, I think this is where resistance is going to be. This may range for another 16 months, 12 years, whatever. As long as this range holds, that will be the expected level. So if I'm buying Link at all in this zone, I'm putting a certain percentage of asks in this zone from 12 to 14. Sometimes it's the whole stack. Sometimes it's 25%, 50%, etc. That's up to you. And sometimes it overshoots it. Sometimes it undershoots it. But for the most part, this is where you'd expect price to go once we break out of this range, at the very least, right? So if you're being conservative, you'll take, I don't know, 20% of your stack, stagger the asks here. As it breaks out, as it gets to that level, we'll see what happens, right? We'll see if we just get straight up continuation. We'll see if we can let our runners run. We'll see if we get the formation of a reversal pattern. But we've already got something mapped out, right? We don't have to think about it. We don't have to stress about reading tweets or analysis or news. It doesn't matter. You know, that's where we think price should go. Another quick example is ETH. If we say, okay, we think this is, again, a defined range. Doesn't really matter what we think the pattern is. This is likely the high based on several rejections, right? There's a bunch here. So It's pretty straightforward, and we know where the low is. There's in 1 point, right? It's at the bottom. So we can use that on the weekly now to give a projection of where we think ETH may go. And I really do this every time. It really is this simple. And I don't think about it. Okay, 26 to 3K, great, right? You know, people have feelings about ETH, et cetera, et cetera. Doesn't really matter to me because that's where I think price would go. You know, and then after that, you can say, well, there's horizontal resistance pretty clearly at that level. That's certainly confluent with where we think price may go, and that may influence then where we put our asks at any accumulated ETH we've held during this range, right? Now, it's not saying we're guaranteed to hit those levels, we're guaranteed to turn around, we're guaranteed that we're going to hit that to the penny. It's just saying, look, the probability is extremely favorable that we make an attempt at the very least for this level, which is why I like using fibs for everything, really. And again, here's an example on BTC. This was a massive mess. This was news, anger, fear, capitulation, you name it, right? But it was also a pretty defined range that you could box off. And wouldn't you know it, we hit that 1618 level around 30K. So if I'm trading a very specific setup or a very specific range, that's where I'd expect it to go every time. It never changes, right? Doesn't always get there. Sometimes it pulls back. Sometimes it takes a minute to get there, but that's usually the super obvious place for prices to move. Now you'll notice if you are looking for bearish retracements most of the time for crypto, because we've had these crazy parabolic moves to the downside, you'll either get like a zero extension, you know, it'll be like infinite basically because it'll just go off your screen, or you have to adjust it slightly. So it's not always perfect on the downside, but always try to identify a specific horizontal that'll really help make that decision. And sometimes you just can't, right? Like if you wanted to use the previous all-time high and then this low, projecting that down, that wouldn't really help you because again, you get basically infinity, right, to the downside, an extreme negative number. So it's not going to always work on the downside. And you're not always going to like the value that it gives you either, right? If we take this range from 2018, certainly something somebody talked about at the time was this idea that if we flip bearish, this is where we could go based on this defined range. So instead of taking the ultimate all-time high at that time to the range low, which would give you, again, a value that is below zero, doesn't help you. This tighter range at least gave you some idea of where price could go, and that's inevitably where we then consolidated once we found that low. But if you were bearish in this period and looking for levels, and as we're breaking down, you're thinking, no, this has to go further. We've consolidated for an extremely long time using this specific range, right? This gives you, at least me, it gives me the confidence to say, yeah, I'm going to keep holding this position. I know where this should go until I see some extreme evidence to the contrary. That's probably where we're headed, right? And you'll see this all the time, at least in my analysis. Range high, range low, this is oil. It doesn't matter what the chart is. It doesn't really matter what the time frame is. Very likely price, once it establishes a range and breaks out, will try to go to that level. Here's an example on ETH BTC. One thing I've noticed for ETH and for alts in particular, they do tend to overshoot that 1618 and 2 range. So this was 19 to 21. We had a inverted head and shoulders, messy range. Using the resistance, the neckline, and the extreme low, that gives you a level between 05 and 06, right? Now it actually went to 06 and 08. So if I'm, quote, letting runners run, this is something you can certainly use. You still use the range. If it blows past your defined level, just use the 2618, the 3618, the 4618, right? The 5618. May not necessarily help you make a trading decision in the moment, but it will help you establish some sort of guidepost again on where we're looking at levels. Here's Bitcoin from May 19 high to the COVID low, and you can see it kind of blew past by a lot. It made to make a pit stop at a certain level, but it blew past that and went all the way to a 5618 based on this range, right? So certainly not a common occurrence, but something to consider, that this thing can go to an extreme direction once you have range high, range low, projected upward in this case. And the next bull run, 100 to 125, is an extremely comfortable target should we make a new all-time high That's where I think we'll go at a bare minimum, right? We'll see what happens when we get there. But if this range holds, we can say today here right now definitively that, yeah, 100 to 125 looks good. And it's kind of the same reason I'm worried about EPTC if you're bullish, right? If you're bearish, you're like, yes, I think this is where it'll go. But then we can start adding on some other indicators that I like pivots, like volume profile of the visible range. We get some confluence factors, again, based on range high, range low, projected downward. 1.272 can be valuable over an extended period of time. And this is, multi-year range. We typically don't break down or up for multi-year ranges extremely quickly. So that's something to keep in mind. So we may make a pit stop here at 045, which was basically the neckline. Ultimately, though, we should try to reach for the 035 level if this does actually break down. It looks bearish, it should behave bearish, but until it actually makes a lower low, there's no guarantee, right? But if it does, then we can say, okay, we know where this may go. This would be the extreme case, right? 021 or 019 or whatever it is. Certainly not the base expectation, but based on the confluence with the fibs, the volume, 035, 032, certainly reasonable as far as an expectation for a downside. Again, with the link example, if there's a defined range on anything and you know where it might go, I'll just put my orders on the book right then, right? I don't need to worry about doing it after the breakout or what the stop loss may be. If this breaks down and you need to get out of your trade, there'll be plenty of time to do that. I would much rather be prepared for the winning trade, than necessarily be worried about getting stopped out if I'm confident in one direction or another. So having some of the stack in the predefined area, certainly viable. One other thing I'll mention with the cloud on the high time frames, it's not a fib again, but it is a 50% retracement, which are, fib adjacent, fib related, let's say, where we're always making a 50% retracement. That's more Dow theory than fibs, but on the chart, it'll give you a visual aid for that 50% level. And that's where, these edge to edge ideas really come from, is this idea that we will mean revert after we make a defined range and return to that 50% level. One other thing I'll mention is on diagonal levels or diagonal support resist, it can be more of a challenge to figure out where exactly to draw the fibs from. In this case, again, you can use, this is gold, you can use a specific high or a horizontal range. And then from there, you kind of have to pick and choose. Do I take the fib from the middle of the pattern or the range, or do I pick the current local low right on the diagonal? That's up to you. But again, here with gold, the expectation certainly is that we keep going based on the fibs. And that's one reason why I've been concerned on this Bitcoin chart for lower lows, because I know where the fibs point. The fibs point to 20K, essentially. And this is an if this then that statement. If we break 24.8, I like 20K, right? I like a pit stop at 23 based on the 1.272, based on the volume profile. But ultimately, I like somewhere in the 20s, low 20s, based on the fib extension to the downside. Here's just some more examples. This is AVAX. Again, high, low, projected downward. Did people think we were going to 12 when we were at 90, when we were at 100? Probably not. Using the line tool instead of candles can help you pinpoint those highs and lows as well. But it gives you some idea if things get bearish, right? This is where price could go. It took a while, admittedly. It took almost a year, but now it's even less than 10, right? Another question probably is, how do we measure this range? Is it really a defined range? Is it a nasty trend, right? And at this point, fibs probably wouldn't help you, because if you project this downward, you get numbers less than 0, is my guess. Here's a SOL example. I know a lot of people looking at SOL recently. It's also diagonal, so it's kind of a mess. But again, if we pick some sort of range high and low that makes sense, then we can start to project where this might go, right? 74 to 89 is like a 3 or 4x from here. But I don't hate that level simply because of the depth of the pattern. Now, I'm not confident that it'll play out that way, but it may take a year, 2 years, 3 years, I don't know. But based on the depth of the current range, that's the projection, which also aligns with a local bottom at that time. One other thing last thing I've seen people use fibs for is sort of looking at current market conditions compared to some other market condition and saying, in the last pre-halving year, we retraced to the 618 fib, or whatever fib it is, of our range. So in this case, currently it would be 48.6K. Got the cloud level on there as well, the 42K, which is again a 50% retracement of a defined range. So if we say, you know what, we think we're going to the 618 fib because in 2019, that pre-halving bull run put us to the 618 during that period of time. And that, that's reasonable to expect that, but I certainly prefer just using the cloud, using the 50% retracement. So I certainly use fibs for just about everything, anytime on any market, and I've used them enough to know that I have confidence in them to put bids or asks at specific levels based on the fibs. So finding the range is important. Find that high-low, play around with the fib tool, and have some fun. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.